As of this writing, December 2020, the real estate market is exploding because we've held super low interest rates for almost a year. With the ability to lock down a super low interest rate, that means first-time home buyers and repeat buyers alike have been salivating at the homes presently on the market. But if you haven't bought a home before, or if it's been a while since your last purchase, you might have thought to yourself, wow, these prices are up. Can I actually afford this? That's a good question. Well, there will inevitably be a real estate crash at some point, and some people think it could be next year, which could be your opportunity to get into the market. Knowing beforehand how much house you can afford, and if you qualify to buy one, are both very important, which is why you should watch until the end of this video. Firstly, let's be straight with each other. Your realtor and your loan officer are not a good resource for how much house you can afford. Why? Their commission is based off how many dollars of house you purchase. So if you buy a $1 million home and go bankrupt next year, it doesn't affect them because you've already guaranteed that they're not going bankrupt. I love my realtor, but I always notice when I ask, how much do you think it will rent for? Or how much do you think this house is actually worth? She coughs up some very optimistic numbers. This doesn't mean you can't or shouldn't trust your real estate team. They might not be scummy, but they do have an ulterior motive which might conflict with their fiduciary obligation, which is an obligation legally. They have to advise you what is in your best interest. The catch is that's very debatable. So they might try to get you the largest loan physically possible, even if it's bad for you. Which is why you need to do your own research, and subscribing to Relentless Growth is a great starting point. At the end of the video, we'll do a lightning round of what you'll need to be able to buy a home, not just how much home you can pay for. Investopedia recommends that most people purchase a home that is 2 to 2.5 times their annual income. I don't know about you, but I think for most Americans, that kind of makes buying a house impossible. And even with a spouse doubling the household income, that cuts it kind of close. The median American income, pandemic notwithstanding, was $50,000 a year. The median home price? Around $300,000 a year. For myself personally, I am not going to use this, because mortgages are long-term and low-interest debt. We were talking about short-term or consumer debt with a high interest rate. The total amount of debt would mean a lot more to me. But for a loan that's going to take decades to pay off anyway, and where the debt is cheap, I care a lot more about the month-to-month. Mortgage lenders generally will approve you for a 50% debt-to-income ratio. My lender said 50% for me, but a lot of articles online are telling me 43%. I'm still going to use 50% for the example. So that means that if you make $4,000 a month before taxes, they'll approve you to have a debt obligation of $2,000 per month. This does not mean that you can have a $2,000 mortgage, necessarily. If, for example, your student loans are $500 a month and your car loan is $250 a month, you only have $1,250 left to work with. Go ahead and pause the video and take a minute to cut your monthly income in half, then subtract your monthly debt expenses. This is the monthly mortgage payment you would likely qualify for. Awesome. Now, let's check what interest rate you can get. We're going to assume that you're buying a house for the first time for yourself to live in, and you're making the minimum down payment. Google conventional mortgage rates, and then click on the bank rate option. Right now, that gives us 2.5 to 3%. It will vary based on your credit score, but we'll call it 2.75%. Now, follow the link in the description below and open a tab on Zillow. From Zillow, I want you to check your own zip code for homes in your area. You'll probably want to filter it down to the correct number of bedrooms and bathrooms that you can see yourself buying. Open up a few of these homes and look at their estimated annual taxes, insurance, and any homeowners association or co-op dues. This may be presented as a monthly number, so you'll have to multiply it by 12. You'll have to scroll to the bottom of the page to find these numbers, and some of them could be missing. Whatever the average yearly total is for these expenses, write that down. Now, go back to the mortgage calculator link. Put the average annual total of the taxes, insurance, and HOA dues under either taxes or insurance space and leave the other at $0. Now, put in the interest rate that you found on Google for your credit score and select the 30-year option. Pro tip, I recommend you round up all numbers that cost you money and round down all numbers that make you money to err on the side of caution. You can now play with the mortgage amount until it matches your remaining available debt obligation or is a little lower, and that number is how much house you can afford. Ignore your down payment. It's only 5% for a primary residence conventional mortgage, and some of that will be made up for based on any closing costs you finance. For example, I just bought a place where I offered $230,000, but I ended up financing $236,000 because I didn't want to take the cash out of hand for all the closing costs. For my area, I used $3,000 a year and $250,000 for the house with a 2.75% interest rate and a 30-year payoff term. This shows that the imaginary house we're looking at would cost me $1,270 a month, meaning based on the example income of $4,000 a month, I just barely can't afford it. You also need to realize that just because you can afford it does not mean you should afford it. The loan officer will give you the loan, but if you're broke afterwards, you'll be stressed all the time because the bills are tight and you won't be able to handle any unforeseen circumstances like a leaky roof or your car exploding. It's also important that you be able to save and invest every month. Because of this, regardless of your debt to income ratio, you'll see a lot of articles and other YouTubers and books tell you that the mortgage should be no more than 28% of your post-tax income or something like that. I don't worry about the percentage. Use that calculator to figure out how much the homes that interest you would cost and then look at your budget. You want to be able to comfortably afford this place and still be saving and investing money every month so that your wealth grows. Only buy a house if it allows you to still live comfortably below your means. In my case, I bought a condo for less than $250,000, which is much less than what I can qualify for. As a result, I have cash left over every month to save and invest. It's cheaper than an apartment, and there's still a spare bedroom. If being able to do this means waiting to buy your first property until you have a bigger down payment or getting a smaller place, that's okay. Risk and reward tend to correlate, but if you go bankrupt, that's going to set you back from getting rich. Remember when I said at the end we do a lightning round on what you need to qualify to buy a house? Well, before that, look above for another video talking about common home buying mistakes. Alright, lightning round. You need a credit score of at least 640, but ideally 740 or higher will give you the lowest possible interest rates on a primary mortgage. Technically, a lower score can work for some financing, but at that point, I just don't recommend you buy a house, but it's your choice. Higher than 760 can still improve financing in some cases, but that's usually things like a HELOC, a secondary mortgage, home equity loan, reverse mortgage, stuff like that, non-traditional financing. You do need a 5% down payment. A lot of people think you need a 20% down payment. That's only if it's an investment property. If you're going to live there, it's only 5%, which can still be a lot of money. You'll also want closing costs saved up. Besides the down payment, there are other closing costs. Some you can partly finance, like legal fees to a lawyer or loan officer fees. Some other hidden closing costs will be things like paying for an inspection and an appraisal. I've often heard assuming 3% for this, but in my case, I've just been assuming that I'll need $8,000 to $12,000, and this has worked in Florida and Maryland so far. For example, I offered $230,000 on my current home, but financed $236,000 against it because I didn't want to eat all of the closing costs out of pocket, and that moved my closing costs from $14,000 to $8,000. As soon as you put in your offer and it's accepted, you'll be expected to put down an earnest money deposit. This is just a check or money order proving to the seller that you're serious and financially capable of closing on the house. In my case, my most recent EMD was 1.5%. A good realtor will warn you of this well in advance, but to most agents, this is also just automatic knowledge, so they might not even think to tell you about it. Finally, you should also have an emergency fund. Some people will say that you should expect 1 to 3% a year in maintenance or have a 6-month mortgage emergency fund. I do not complicate it that much for myself. I keep $5,000 in cash and another $5,000 in stocks for each property. For an example, $300,000 home, the median home price in the US, this would work out to a $15,000 down payment, $10,000 in closing costs, just under $5,000 for the earnest money deposit, and then, if you're following my recommendations, you make your own choices, another $10,000 as an emergency fund for a total of $40,000 to buy the average house in America. This can vary case by case, but for the most part, I've rounded numbers against us. So if you're buying with primary residence financing and have $40,000 saved up, you should end up with some leftovers, but verify all this with your own realtor and loan officer. Yes, that's a steep price tag. You could probably skip the emergency fund, but if a storm blows out your windows next month after you've bought the place, you'll regret not having an emergency fund. Thanks for watching. If you'd like more real estate content, check out the playlist on the screen. YouTube is also trying to pick what videos of mine they think you would like best, and if you subscribe and hit the notification bell, you will be told next time that a video comes out. You only have one life to live. Grow it relentlessly.